Welcome to the Deep Dive. Today we're digging into your stack of sources. All the filings, the analyst chatter, market news from the last 24 hours or so. We're focusing on October 24th and 25th, 2025. And our mission really is to cut through that noise for you. We want to pinpoint which companies, maybe in fintech, media, health, consumer, are making moves. You know, who's facing regulatory heat? Who's showing like real insider confidence? Or just getting tossed around by M&A rumors. Because when info flies this fast, knowing why something is moving is just critical.
It really is. And what we're seeing, I think, is the market just constantly trying to figure things out. It's not just what's happening, but the reaction to it, distinguishing between, say, an immediate jump on a legal brief versus that depper momentum from a solid earnings beat, or even just, the signal from a CEO buying their own stock, that tension, regulation versus conviction that really defined the last day or so.
Okay, perfect way to frame it. Let's start with digital finance then. Because it feels like ground zero for that exact tension you mentioned. We've got these big regulatory hammers coming down right next to some pretty massive votes of confidence.
Yeah, the contradiction is quite something. So on the negative side, two big names. First, PayPal. The EU Commission, they've launched a new antitrust investigation. They're looking into potential anti-competitive stuff with their digital wallet services.
An EU probe is never small news, is it?
No, absolutely not. It's a serious headwind. It signals, major scrutiny, potential fines, maybe even changes to how they operate down the line.
And that wasn't the only regulatory hit, right?
Yeah.
Coinbase also had a rough day.
That's right. Over in the U.S., Coinbase stock dropped, around 6%?
Yeah.
And that was tied directly to the SEC. They filed a supplemental legal brief in their ongoing case against Coinbase, basically strengthening their argument that certain crypto assets traded on the platform are securities.
So the SEC's just digging in its heels on that one.
Seems like it. They're not easing up. If anything, they're doubling down.
Okay, so regulatory hammer falling in Europe, regulatory hammer falling in the U.S. But then, look at the other side. This is where the confidence part comes in. SoFi. The CEO, Anthony Noto, filed a Form 4. He personally bought shares.
Yep, about 25,000 shares, valued at roughly $500,000.
Wow, okay.
And the market reads that loud and clear. I mean, a $500,000 buy from the CEO. That screams, I think my stock's undervalued. It's a powerful internal signal.
Definitely overrides some of that external noise.
It often does. And we saw similar strength, though maybe for different reasons, with Lending Club. Their shares jumped over 12%.
Right, but that wasn't new news exactly, was it?
Not exactly new, but sustained momentum. It was fallout from their really strong Q3 earnings beat, which they reported 2 days prior. The market was still digesting that good news.
Got it. And Affirm, too, right? Still climbing.
Yeah, Affirm kept its momentum up about 5%. That seemed linked to the positive reaction to their expanded partnership with WorldPay, which they announced the day before. So, lingering good vibes there.
But it wasn't all positive signals, even on the confidence side.
No, definitely not. Upstart, for example, fell 4%. That came after Morgan Stanley just reaffirmed their underweight rating and their price target.
So one analyst sticking to their negative view can still weigh things down.
Absolutely, especially if it taps into broader concerns like, lending risk in the current environment. It shows how sensitive things are.
And Block. Anything major there?
More of a product update for Block, formerly Square. They launched a new feature in Cash App called AI Savings Pods, trying to help users save better. Interesting, but not the kind of news moving the needle like the regulatory stuff or that SoFi buy.
Okay, so fintech. A story of regulation versus insider moves. Got it. Let's shift gears to media. This feels like a whole different beast right now. All about speculation, M&A.
Oh, absolutely. M&A rumors are driving huge swings. And the biggest story there, hands down, has to be Warner Bros. Discovery, WBD.
Right. Bloomberg had that report.
Exactly. Bloomberg reported that WBD is starting to actually share financial data with potential bidders.
Okay, that's more than just rumor then. That's procedural.
It really is. It's a sign that a major sale process, maybe for parts of the company, maybe the whole thing, is really intensifying. And the stock surged on that news.
Because the market's trying to price in that M&A premium instantly.
Precisely. They're anticipating a deal at a higher price. It just shows you, like you said, where the value creation is seen in media right now, potential consolidation.
And there was a figure mentioned about the CEO, Zaslav.
Yeah, the report mentioned he could potentially gain something like $500 million personally if a sale goes through. Just adds another layer to the story.
Okay, so WBD's maybe heading towards a sale. What else is moving in media? Disney.
Disney's facing a different kind of pressure. It's about content distribution. They're in really critical negotiations with YouTube TV.
Uh-oh. What happens if those fail?
Well, the report suggests that major Disney channels, think ESPN, ABC, local stations, they could get dropped from YouTube TV. That's a huge disruption for subscribers and a big deal for Disney's revenue streams.
That's a high-stakes negotiation.
Very high stakes. On a different note for Disney, we saw an institutional investor, Sumitomo Mitsui Trust Group, actually increased its stake. So some big money still believes in the underlying assets despite these, tactical fights.
Interesting contrast. And Netflix, they had earnings recently.
Yeah, they missed expectations recently and stock took a hit. But then Cathie Wood's ARK Invest reportedly stepped in and bought the dip.
Ah, classic ARK move.
Pretty much. It's a bet against the market's short-term reaction. ARK is basically saying, you're overreacting, we see long-term value here.
Okay. And Roku, anything specific there?
Roku's got earnings coming up October 30th, so there's a lot of market attention building. The chatter is around reports noting they still dominate the open programmatic connected TV advertising market, CTV ads.
Which is where the ad money is flowing.
Exactly. So that dominance is key. And just briefly, Comcast, analysts are projecting an earnings decline year over year for them, reflects those ongoing struggles in traditional cable and broadband.
Right. Okay, let's pivot again. Health and life sciences. Feels like M&A and maybe some internal shakeups are the story here.
That's a good summary. The big M&A news came from Eli Lilly, LLY. They announced through an 8K filing that they're acquiring Adverum Biotechnologies, ADVM.
Okay, straightforward acquisition.
Well, yes and no. The structure is interesting. It's $3.56 per share in cash, plus something called a contingent value, right? A CVR.
A CVR, what does that mean practically?
It means there's potentially more money, but it's not guaranteed. The CVR could add up to another $8.91 per share, but and this is the key part, it's contingent on Adverum's product candidate, Ixo-vec, hitting specific clinical or regulatory milestones.
Ah, so Lilly is saying, we'll pay more, but only if this drug actually works out.
Exactly. It's a way to share the risk and the reward. Shows they believe in the science, but they're hedging the bet based on actual results. It's quite complex.
Very interesting structure. Now, Teladoc, TDOC, seem to have some conflicting news. All in one go.
Yeah, that was a bit confusing for the market. On one hand, operationally, they reported preliminary Q3 numbers that look pretty good. Revenue slightly beat estimates, and their adjusted EBITDA significantly beat estimates, $69.9 million.
Okay, that sounds positive.
It should have been, right. But in the very same 8K filing, they announced their CFO, Malamurthy, is resigning, effective November 21st.
Oh, to go where?
The filing says she's pursuing opportunities outside the healthcare industry.
So strong results, but the CFO is leaving. How does the market even process that?
It creates uncertainty, doesn't it? Even if the numbers look good now, a CFO leaving, especially when the company's still navigating its path forward, it just raises questions about strategy, internal alignment. It kind of dilutes the impact of the good operational numbers.
Yeah, I can see that. Any other quick health notes?
Just briefly, Hims&Hers. Hims got some positive analyst comments about their AI strategy for personalized digital health. And we saw some institutional buying in health tech infrastructure. Ethic Inc. picked up some Viva Systems, VEEV, stock.
Okay. Let's move to consumer and apparel. We have a really clear winner here, don't we? Deckers Outdoor.
Oh, yeah. DESA. They absolutely crushed their Q2 FY 2026 earnings, just knocked it out of the park.
What were the numbers?
They delivered $1.82 in earnings per share when the expectation was more like 1.8, and revenue hit $1.43 billion.
Really strong.
And what drove that? HOKA.
UGG.
Both, really. HOK brand sales were up 15% and UG brand sales up 12%. Just solid growth across their main brands. And management felt good enough to reaffirm their full-year guidance, too.
Okay, so strong beat, reaffirmed guidance, sounds great. But the analyst reaction wasn't uniformly positive afterwards.
That's the funny thing, right? It was mixed. You had Baird and Needham setting really high price targets, like $125, $130. But then Truist Securities and TD Cowen actually trimmed their targets slightly, even after the beat.
How does that work? They beat, but you lower the target.
It often comes down to expectations versus reality, especially with high-growth stocks. When a stock is priced for near perfection, maybe the analyst thought HK growth should have been even higher, say 16% instead of 15%. Even a great result might signal a slight deceleration in the rate of growth, which makes some analysts a bit cautious about the future, especially given concerns about consumer spending.
Wow, tough crowd. Okay. What about other apparel or consumer names?
Let's see. On holding, ON, got a boost. Raymond James kept their outperform rating after the stock did well relative to the market. Seems like some positive momentum there.
And Celsius, the energy drink company.
Yeah, CELH. Market analysis seemed focused on things like options activity and also looking back at the positive impact of their acquisition of Alani Nu, still digesting that deal's effects.
Okay. Nike, Lululemon. Any noise there?
Just some analyst coverage acknowledging their recent stock weakness. They haven't performed that well lately. But the commentary mostly highlighted that the underlying brands, Nike and Lululemon, are still fundamentally very strong.
Right. Brands with staying power. Okay, final stretch. Let's look at sectors sensitive to rates and consumer finance. Housing, autos.
Yeah, these areas are really reacting to the broader macro picture. Expectations about interest rates, consumer health, that's what's driving things here.
And we saw some serious legal pressure emerge too, particularly for CarMax.
We did. CarMax, KMX, is now facing investigations from several law firms. They're looking into potential securities fraud.
Stemming from.
It stems directly from their disappointing earnings report back in September. The core accusation is that management might have misled investors about demand levels and, crucially, about how much money they were setting aside for potential loan losses.
Connecting the dots between macro pressure and how the company prepared for it?
Exactly. It's about risk disclosure and management accountability. Separately, on the legal front, BellRing Brands, BRBR, actually finalized a settlement for those class action lawsuits related to their joint juice product.
Oh, so clearing up some old baggage there.
Yeah, resolving litigation is usually seen as a positive, removes an overhang.
Now, speaking of macro, you mentioned housing reacted strongly to economic data. Offerpad.
Oh, dramatically. Offerpad, opad, the stock jumped 10.3% in a day. Just soared.
What caused that huge spike?
It was a direct reaction to unexpectedly low inflation numbers, the CPI figure.
The lower inflation means.
Lower inflation fuels hope that the Federal Reserve might cut interest rates sooner rather than later. And for a company like Offerpad, which is super sensitive to mortgage rates and the housing market's health, even a hint of future rate cuts is like rocket fuel. Their whole business model depends heavily on the cost of capital and people being able to afford homes.
So good inflation news immediately boosts these housing tech stocks.
Instantly. And we saw related analysis pop up for Opendoor, Open, and Zillow, Z focusing on their agent partnerships and strategies. Opendoor even got a mention from the Motley Fool as a potential growth stock for 2025.
Interesting. Any institutional moves in that space?
A bit mixed. Nordea Investment Management cut its stake in Zillow, but other big institutions were increasing their holdings in XP World Holdings, EXPI, so some differing bets there.
And Carvana. Still riding high from recent analyst upgrades.
Seems like it's still benefiting from that residual momentum. JP Morgan Stanley had raised their targets recently, and that turnaround story seems to still have some legs, according to the market.
Got it. Lastly, insurance. Anything major before earnings?
The insurance sector, think Allstate, AL, Progressive, PGR, Lemonade, LMND, Hippo, HIPO. It feels like they're in a bit of a waiting period right before Q3 earnings hit. The big focus for investors is going to be the impact of catastrophe losses, especially from the recent hurricanes, particularly for companies like Allstate. And for Progressive, the question is, can they keep up that strong margin improvement they've been showing? That's been a key part of their story lately.
Okay, wow. We covered a lot of ground there. From the EU and SEC cracking down on fintech,
right,
to the massive potential shakeup at WBD, driven purely by M&A talk.
Huge swings there.
And then those really strong immediate reactions to earnings beats like Deckers and Lending Club.
Yeah, the operational wins definitely got noticed.
So what's the main takeaway from all this churning over the last 24 hours?
I think the key is really understanding the type of information you're seeing. Is it a mandatory SEC filing? Like that SoFi Form 4? That carries real weight. Is it a confirmed regulatory action, like the EU probe into PayPal? That signals potential long-term structural risk. Or is it an analyst opinion, like the Morgan Stanley downgrade of Upstart? That's an expert interpretation, sure, but it's still an opinion, not a fact direct from the company or regulator. Sorting through that hierarchy, filing versus action versus opinion, is just crucial to making sense of it all, separating the signal from the noise.
That's a great point, hierarchy of information. Okay, so here's a final thought for you, our listener, to maybe mull over.
Yeah.
We saw that huge, immediate positive reaction to the SoFi CEO buying $500,000 of his own stock, a real skin-in-the-game move. So the question is, how heavily should you weigh that kind of insider buying that sign of personal conviction compared to, say, a well-reasoned analyst downgrade when you're forming your own view of a company?
Yeah, it really makes you think about who has the better information, doesn't it? The insider looking out or the analyst looking in, and who's risking their own capital.
Something to chew on. Thanks for diving deep with us today.